Much. This is a joy. His name is James Macey. He's with Forrester's Financial. There's a rumor, Paul Sweeney, that he actually knows his way around a Bloomberg terminal. It's a modest rumor.
That's a must for the
modest rumor out there. But after the Powell meeting, the Powell put, you got to talk to a guy with an astrophysics degree from the University College London, UCL, and he joins us right now. James Macey, wonderful to speak to you with all your work at Lehman over the years and with Goldman Sachs and now at Forrester Financial. What did Chairman Powell do for the equity markets yesterday? Did he provide us with more stability where the drift is calmer, or from a quantitative basis, is there going to be a lot of noise in the future?
Well, good morning, Tom. I'm certainly a big fan of the show and honored to be here this morning. Well, clearly the markets liked what Powell said yesterday, right? We saw that with the market reaction immediately as soon as he began talking about basically the current state of the economy not being as bad as many people had imagined in December. Now, to me, what I took away from this is that the statement didn't have any forward guidance. But many in the market took yesterday's statement that the Fed is done raising in the current cycle, and that was the big fear into the fourth quarter and at the December meeting. The Fed didn't say what balance sheet size that it would be taking, but look, certainly equity saw it as very positive. Short-term rates came down a bit, dollar was down, curve steepened, but this was what I would categorize as a risk relief rally.
So, James, are you one of those folks that feels that perhaps this Federal Reserve and this Fed chairman may be overly attuned to market volatility as it thinks about its policy?
Yeah, look, when Powell was asked yesterday if the Fed is caving to President Trump, Powell said no. Powell says he's patiently waiting greater clarity. But look, the Fed is data dependent and will remain data dependent. And if the Fed doesn't see that an economic drawdown is in the cards, what I question is, what is the difference in data that we've seen from the December meeting to this meeting? In my mind, not really much has changed since then. Data-wise, there certainly hasn't been changed. The market reaction and significant volatility that we saw has changed. So, Powell is saying that he's not looking at the market reaction and doesn't cave to political pressure, but perhaps there is something there that he is looking at the market reaction. We think that volatility is here to stay for a little bit longer. And look, I think we're in an inflection point right now in the market, and that's the important thing. We've seen a long bull run in equity markets. The S&P is up 387% since the end of the crisis, 17.4% annualized. We just don't think that that's realistic going forward.
So, James, do you think did you get any color or any additional color from Chairman Powell's comments and the statement yesterday about where you think they want to take this balance sheet? There is a wide variety about there's a $2.5 trillion, $3.5 trillion. I mean, did you get any sense of where you think that's going to be?
No, I didn't get a clear sense about that, to be honest, and I probably would have looked for some additional color. I think many in the market were concerned about the impact of changes to the Fed's balance sheet. To me, there wasn't as much color on that side of things, but to me, the big takeaway was, look, we've calmed investor nerves and confidence right now in the market by basically saying, look, there's no rate hikes that are on the cards. The Fed is going to remain data dependent.
James, I want to go mathy on you here. We can do that when it's 4 above 0. There's a thing called a log normal distribution, which translated, folks, is when you go up at a certain slope, and when you go down faster than the rate that you went up. To make it simple, his passive investing and the way people are hands-off, ETFs and passive, has that changed the general log normal slope where going up is a certain rate, but particularly, has it changed if we go down big, we go down at a different rate than normal of the past?
That's a great question, certainly something that is on our minds as well. Huge inflows that we've seen into passive vehicles such as ETFs, huge outflows as well, right? So we saw huge amounts of money going into levered loan ETFs that changed abruptly. Sentiment changed as well. But what we look at is similar. Tom, you're a Patriots fan. I heard you talking about the Arsenal team earlier on. The headline volatility, the headline numbers that you see in indices, and when you're buying an ETF, you're buying an index, such as the S&P 500. There's a lot of volatility and things that kind of lurk beneath the surface. So what's interesting, if you think about the S&P 500 headline volatility, which spiked, the VIX spiked. but a lot of people don't look beneath the surface and peel the layer back of the onion. Now, what's interesting about the S&P 500, for example, is about 450 names, individual stocks within the S&P 500 are more volatile than the index itself, and that's historic. That you see that trend over long periods of time. So, looking beneath the surface of these ETFs and indices is very important.
James, you can come back because Paul Sweeney he's got a normal distribution in the back, and then he goes small sigma equals 1 over n delta x minus mu squared. Take the square root.
You lost me there.
Okay, that's okay. James Macey, thank you so much.